Imagine you're putting money into a savings account every month without looking at the stock market. Now let's twist that idea. What if you invest in stocks or funds by putting in a set amount of money each month? This strategy is called dollar cost averaging, and it can be an effective approach to investing because it smooths out the impact of volatility on your investment over time. Let's say you have $120 to invest every month for 5 years, or 60 months. If you put all your money into one lump sum right now, how much you would earn depends on the market's performance at that specific point in time. But let's look at what happens if you spread out your investments over time through a strategy called dollar cost averaging instead. First, imagine you start investing in a fund with a price of $10 per share in January. You invest a fixed amount, say $120, buying 12 shares. In February, the price drops to $8 per share, so your same investment buys more shares, this time 15 shares. By March, the price goes up again to $12 per share, and with the same $120 investment, you buy 10 shares. See how the number of shares varies depending on the average price paid. Now let's do some math with real numbers. Suppose in January the fund is at $10 per share. You invest $120, getting 12 shares. By February it drops to $8, so you get 15 shares for your $120, since 128 equals 15. In March it goes up to $12 per share, and you buy another 10 shares. $120/12 equals 10. By the end of these 3 months, how many shares do you have? You've got 36 shares in total. And what's your average cost per share? It's around $9.72, which is lower than if you had bought all at once when it was $10. Here's the kicker: this strategy can reduce risk by smoothing out market fluctuations. If you invest a fixed amount each month, you buy more shares when prices are low and fewer when they're high. Over time, your average cost per share tends to be lower than if you tried to consistently predict market highs and lows. Let's look at an example with real data. Imagine you start investing in a fund that tracks the S&P 500 index. You invest $100 every month from January 2010 to December 2014, which is 5 full years. Here is how it plays out. In January 2010, the S&P 500 index was around 1,137 points. If a stock or ETF tracking this index cost about $10 per share, and you invested $120, you would buy approximately 12 shares, assuming no fees. In February, if the price drops to reflect an index value of around $9.33 per share, not directly tied to S&P 500 point changes, but illustrative for this example, your $120 investment now buys about 12.87 shares, giving you more exposure at a lower cost. By March, the index jumps back up to around 1,167 points. Your shares are now $9.50 each, so you buy approximately 12.63 shares with your $120, since 120/9.5 equals 12.63. Keep doing this month after month. By December of the same year, the S&P 500 is at about 2,043 points. Now how many shares do you have? Let's say around 629 shares. At an average cost per share of roughly $7.58, your total investment over 5 years would be $4,755.12. Your shares are now worth nearly $12.86 each, giving you a total value of about $8,096.74. That's the power of dollar cost averaging. It smooths out price volatility, reducing the risk compared to trying to time the market perfectly. It's like buying groceries. When prices are high, you buy fewer units. When they're low, you purchase more for the same amount of money. Now let's compare this with lump sum investing. If you had put in $744 every month, $120 x 6 months, and then invested the remaining amount at once on a peak day in May 2011, when the S&P 500 was around 1,350, your results would be very different. You would end up with fewer shares overall. Even if you had timed your investment perfectly and bought at the absolute low point in early March 2009, when the S&P 500 hit its trough following the financial crisis, you still wouldn't match the steady accumulation of shares achieved through dollar cost averaging over a 5-year period. Here's a key point. Dollar cost averaging doesn't guarantee profits, but it can help reduce risk and may prevent large losses that occur when investing a lump sum in volatile markets. Now let's dive into some numbers to see how fees impact this strategy. Imagine the same scenario, but with a 1% management fee on your investment every year based on the average value of assets during that period. That might not sound like much, but over time it adds up significantly. Your $720 per year, $120 invested monthly, would incur approximately $36 in fees in the first year alone, assuming an average balance of $6,000. Over 5 years at a rate of $36 per month, that's nearly $216 lost just to management fees. And if you add a 1% annual fee to the total investment over those 5 years, assuming an average balance of $5,000, you'd lose approximately $250 in fees, which is significant but not quite half of what you might have earned on your initial investment without such fees. So here's the truth. While dollar cost averaging can be a smart strategy, high fees can significantly erode your returns over time. Always look for low-cost options like index funds or ETFs to maximize your long-term gains. Another important factor is market volatility. During periods of extreme price fluctuations, such as those experienced during a market crash, dollar cost averaging involves purchasing shares when prices are very low. This strategy could result in significant gains if the market recovers, but it also means investing at potentially volatile and uncertain times. But here's what history shows. Over long periods, including during recessions and market downturns, stock markets tend to recover and often post positive returns. So while there is risk involved, the strategy of investing consistently, such as through dollar cost averaging, often pays off more than attempting to time the market perfectly or avoiding dips entirely. Now let's talk about psychology. Dollar cost averaging helps address one major issue. People are terrible at timing the market. Instead of buying high during periods of excitement and selling low out of panic, by investing a fixed amount each month, you can avoid these emotional swings. It's like eating an elephant one bite at a time. You might not see huge gains every month, but over the long term it can add up to significant growth. And by spreading out your investments, you take advantage of average prices over time, reducing the impact of volatility on your investment costs. But here's the important truth that counters the exciting myth. Dollar cost averaging is generally more effective than attempting to time the market to invest all at once. The consistent approach may lack excitement, but it's typically wiser and safer for most investors. Remember, this isn't advice about which stocks or funds to buy. It's educational content explaining how markets function and why a strategy like dollar cost averaging can be effective over the long term. So next time you think about investing, consider the calm approach of regularly contributing fixed amounts each month. This method, known as dollar cost averaging, can help you build your wealth without worrying about market fluctuations. In short, consistent investing often outperforms attempting to time the market perfectly every single time. This is educational and historical, not financial advice. Dollar cost averaging works because it smooths out the ups and downs of the market by spreading investments over time, rather than investing a lump sum all at once. Let's look at a real example. Imagine you have $12,000 to invest over 1 year. Instead of putting all your money into the market right now, you split that amount into monthly payments of $1,000 each month. Now, let's say the stock market experiences some volatility over this period. In January, stocks are high. $1,000 buys 50 shares at $20 each. February sees a dip. $1,000 buys approximately 67 shares at $15 each, more precisely, 66.67 shares. March bounces back up slightly. $1,000 buys 45 shares at approximately $22.22 each, precisely, 45.45 shares. April is volatile again. $1,000 buys approximately 33 shares at $30 each, more precisely, 33.33 shares. By spreading out your investments through dollar cost averaging, you end up buying more shares when prices are low and fewer shares when they're high. Over time, even if there's significant volatility, this strategy can help smooth out the average cost per share compared to investing a lump sum at one specific point in the market cycle, whether it's during a peak or trough. Let's consider a scenario where an investor attempts to time the market perfectly but fails. Investor A invests $12,000 in the stock market right after a significant dip. Investor B employs dollar-cost averaging by investing $1,000 each month for 12 months, totaling $12,000. If the initial dip was indeed a short-term blip and the market quickly recovered, investor A might see immediate gains. But what if it is? If the recovery takes longer than expected or the market dips again later in the year, dollar-cost averaging can help smooth out the impact of price volatility while still benefiting from eventual growth over time. Another key benefit of dollar-cost averaging is that it encourages discipline and consistency. Rather than feeling overwhelmed by having to invest large sums all at once, you can make smaller, regular investments. This approach also helps avoid the temptation to chase after hot stocks or try to predict the market's unpredictable movements. Consider another real-world example. During a major financial crisis like 2008, many investors panicked and sold their investments, missing out on subsequent market recoveries. Investors who adhered to a consistent dollar-cost averaging strategy remained invested through the downturn and benefited from the recovery that followed. Now let's talk about fees. If you're paying even just 1% in management or transaction fees annually, those can eat into your returns over time. With dollar-cost averaging, if each monthly investment incurs a small fee, spreading it out means these fees are a smaller percentage of each contribution compared to putting in the full amount at once. However, while the percentage of the fee is lower with each installment due to the smaller size of individual contributions, the total fees over time may accumulate more than if you made a single larger investment, especially considering compound growth effects on your remaining balance. In short, dollar-cost averaging may seem less thrilling than attempting to time the market, but it is often more effective. It helps smooth out volatility, encourages disciplined investing, and can reduce trading costs over time. This is educational and historical, not financial advice.